In the last 7, 8 years, I've tried thousands of trading strategies, thousands of ideas of trading, from pure technical systems to fundamental to sentiment based systems to other things that are seemingly completely unrelated to trading. Now, after all of that practice and all of those things and all of the evolutions of how I've gone through trading and thinking about trading, I've come to the conclusion that what I'm about to share with you in this video is the area where the biggest possible edge will come from. Now, in order to understand it, we need to circle back a little bit and actually understand a deeper concept, and then we'll bring it back towards this at the end. But I guarantee you that if you watch this video, it will hopefully shed some light on a completely different way of viewing trading, a completely different perspective that maybe you haven't heard before, maybe you have. So let's not waste any time. Let's just get into the meat and potatoes. So, looking for what's considered unfair. What the hell does this mean? Well, the financial markets, right, are regulated, which means that big regulators, so the government or whatever, but at the top, it's going to be the government. They basically outsource different regulatory agencies. So, for example, in this case, for most retail traders, that's in the UK, that's going to be the FCA, which stands for the Financial Conduct Authority. There'll be versions of this in every single country. But the bottom line is that these organizations aim to do a few things, but one of the main things is keep the markets fair and safe. Now, they want this because they don't want one particular person or a group of people to have a crazy advantage over the other people, because that wouldn't be fair. That's not the goal. They don't want it to be an unfair battleground. In the same way as in business, you don't want, 100 people to be the only people in the country who can start a business. That would be really unfair, and that would lead to a huge amount of inequality. So, why am I telling you this? Who cares, right? Because if you want to look for what is considered unfair, that is something that we know for a fact gives you a massive advantage over everybody else. Now, this means that things that are unfair are typically illegal. Now, this is not a video of me going, yeah, go and find illegal stuff and do that. That's not what I'm talking about. I'm saying that in the act of understanding what is made illegal in the financial markets, we can understand a thesis that we can apply to a legal side of things. So what the fuck am I talking about? What is the biggest money maker? So the biggest money maker that's very illegal, that's been proven to have the best results. Because understanding the answer to these three things is going to give us an answer as to how the market functions and how we can potentially apply that in a legal way to trading. So, what's the answer? Well, there are many, many, many stories of people that have done this. But I'm going to explain it to you through a make believe story, just because I can't remember any real life stories off the top of my head. But essentially, let's just say that you are Bob over here. Bob is pretty happy, and everybody else. So we'll put a line here. Everybody on this side was just Bob on this side, but all over here we have, let's just say, 1 million people. So basically, let's just say the market, right? So over here we have the market, but over here we have Bob. Now, Bob has access to information that these guys do not have access to. Now, it's not just any information. We're talking about information that has the power to move the market. So this can be a huge range of things. If he's trading stocks, it's going to be things to do with company earnings, right? Because company earnings, stocks are companies. So earnings are going to be one of the biggest things related to companies. Potentially in other markets, it could be to do with new regulations that come out that affect specific companies or affect currencies or affect other types of markets, right? Otherwise, other things could be, maybe it's taxation, maybe new taxation rules that he knows. Maybe he's in politics. Maybe he knows about it before it's going to be released to the public. Then you've got other things such as, the list is endless. Central bank information. If you work at a central bank, you're going to have information about what that central bank is doing before it's released to the public, right? These are just a few of many, many examples. But really, to summarize, what we're looking at on this side of the coin is we're looking at key market moving information that's unknown to the public. Yes. This is really the key. This is the whole key to being on this left-hand side here. And let's just say Bob is in a position, maybe he works for the government and understands the tax information before it's released to the public. Maybe he works for a regulator and understands that before it's released to the public. Maybe he works for a central bank and finds out, that before it's released to the public. And therefore, he has a huge advantage. Now, of course, because of this advantage, he is not allowed to take action based on this information. If, for example, if you're working for a central bank, you're not going to be allowed to trade a currency because you know something before everyone else does, because it's heavily regulated and they will catch you. Okay. They're extremely sophisticated these days and it's extremely hard to get away with it. Not that you should even try to get away with it because it's extremely unethical. But the premise of this is what is important and the reason that I'm making this video, right? Because this is something that is known to be unfair. And because it's known to be unfair, it gives us an indication as to how and where the best edges are going to potentially come from, right? Not in terms of doing stuff illegal, but doing legal stuff. Because the key words in this are market moving information and unknown to the public yet. Doesn't necessarily have to be completely unknown, though, from a legal sense, but it could be something that most people in the public aren't looking at. Most people are discounting its importance, anything like this. But the market, right, with this, because they don't know, what's going to happen is with an insider, this is called insider trading, by the way, guys. If you look it up, you'll see many, many people have made many billions, hundreds of millions doing this because it works, right? Because the markets are always trying to price in value. Now, we'll circle back to this in a minute. But an insider trader, for example, let's say they get the information here. Let's just say they get it in January, and the information doesn't actually come out until March. Prices could boom, right? They could profit on all this. Then the actual information comes out. The market participants maybe buy it a little bit. They don't get anywhere near as much. But because of the person had his conviction here, he could leverage the hell out of his position. It's not unheard of to make 1,000+% on these types of moves, it depending on what the information is, where this person works, how they obtained it, and all these sorts of things, right? Whereas the person afterwards maybe got only, I don't know, 5%, right? Now this is just an example. And the reason that this number would be so much smaller is because they have less confidence in what they're doing. Therefore, their stop needs to be wider. They need to have a little bit more certainty, whereas this person, because they're so sure, because not the market doesn't know it yet, it's really high probability, and therefore a really tight stop could be used and you get some absolutely ridiculous multiples, right? That is the premise of insider trading. Now, why is this important to us? Well, because what are the markets? What's the purpose of the market? The purpose of the market is to price in value, right? Now, here's the problem. What is value? Is it something that anyone can be right or wrong about? No, because at any one point, there's always new information coming in and there's always new opinions, there's always new emotions and all the other things that are guiding people's decisions. And therefore, true value cannot be a specific thing, can't be a specific number because it's always changing, right? And this is why, not why, but it's one of the reasons why, we see oscillations in price, right? Because people can't decide on a true collective value. Everyone's got their own opinion of what true value is. Some people are looking at the value over the short term, some are looking over the long term. And so obviously the way they behave and the way they create strategies are going to be completely different. And therefore we have all of these fluctuations in price because the market is an auction, right? And with insider trading, right, what you're doing is you are finding game-changing or key market-moving information before everyone else knows it, right? And so you know something about the value before everyone else does. And in the same way as, as going to like a market store or whatever, if you're there first and you know what you're doing, then you're probably going to get the best deals, right? Because that's when the stock is the highest and you have the least competition, and therefore it's where the best gains come from. Now, of course, insider trading sounds great if it was legal and all fine, but it's not legal. And so what is the legal alternative? What can we learn from this? Well, if we understand that value can't be reached, right, but there is an advantage to being the first, it means that the best edges come from new information. New information. Now, not just any information, because, there could be news that comes out that a cat is stuck in a tree and you look at that and you're like, oh my God, this means GBP USD is going to go up. Obviously, that's a ridiculous example, but you know what I mean, right? That sort of information is not going to be key because the information doesn't mean anything. And so, what I'm going to talk to you here about is the things that I've found that are the most important characteristics of the biggest moving new information. Now, there are certain things of this that I won't be sharing on this YouTube channel just because it's taken me a long time and a lot of work and a lot of testing to identify certain relationships between different types of information and the results that they tend to get. And so, those sorts of things, could actually diminish my edge. There are lots of things in trading where sharing it wouldn't necessarily diminish your edge, but the ways that I've done it, sharing it with everybody is going to just cause, the edge to be diminished. But the principles I'm going to share with you allow you to go and find this on your own with your own back testing and looking at your own data and making your own decisions, right? So new information has to have market moving potential. This is obvious, right? If it can't move the market, if you're looking at news about someone, getting, shot or something, unless it's someone really, really significant, it's probably not going to move the market, obviously, right? Second one is going to be ideally brand new slash 100% unexpected news. Again, this is the extreme. I'm giving you the extreme principles here. There are scenarios where you could have news that is maybe they've been expecting a regulatory change for a while, but it's just a bit higher than expected. It's a bit more intense than expected. That's still okay, but I'm talking about the big, big, big new information. I'm going to give you an example as well in a moment. So market moving potential, brand new news, unexpected news. For example, a completely shock rise in a tax or in a specific regulation that's just come in from a government unexpectedly, or a trade agreement or something like that that's come in, or sanctions or whatever. These unexpected things that you'll see on the news, right? Those things are going to be really important. The next one is really underrated, which is a clear consensus. This one is extremely important to understand. Here's why, right? Let's just say you have some news that comes out and you see it over here. You see it and you're like, oh, this is negative news, I think, right? But then what happens is that news is actually perceived as positive. This is the problem that most people run into. If you pick news that's brand new and has a lot of market moving potential, that doesn't mean that the consensus, meaning the sentiment or the opinions of the market, are going to align with what you think. So it may be really important news, but that news could be really good for you, and you see it as good, but to other people, to the majority of the market, they could see it as bad, right? This is why new information becomes a bit of an issue, right? Unless you have new information that has a very specific outcome. Now, a clear consensus in something like stocks could be you have a clear consensus that this is going to increase the company's earnings, right? It's very, very, very slash nearly impossible to have a company that has a significant boost in earnings and their stock price plummets, right? That is unlikely unless the earnings boost was expected. Because again, there is a reason I'm using words like unexpected and new, right? Because expectations are going to be the devil when it comes to trading based on new information. Because new information, it's not new if it's expected, right? And new is a very, very important word here, right? So what does this mean? Well, it means that by having a clear consensus, meaning if we have news that comes out and it's so overwhelmingly obvious that this is going to be perceived as negative, then that is going to be good, because then we know, okay, it's much more likely that it's going to go in one direction. When I started looking at this way of trading, this was something that took me ages to figure out, because I'd constantly be like, okay, well, I've got this idea. I know that this news is really significant, but I don't know how the market participants going to react. For example, you may have a long-term trader that adjusts their positions because they're looking at things on a 2-year, 3-year, 4-year time horizon. That's going to be totally different than how someone who's trading on a 1-minute chart is going to perceive that news if they're even watching it altogether. Right. And so understanding these things, those little nuances that I just kind of gave you hints to, is really where you're going to be able to refine those really, really monumental edges. Right. So these 3 things are the key. Now let's go to an actual example. So GBP USD, I had a very short-term play on GBP USD last week. The premise was extremely simple. Don't worry about where my entry is or anything like that. I wasn't so concerned about price with this because the news that I was mostly focusing on was the sentiment in the pound. Yes, we did have some news here. We had personal spending, all this sort of stuff, but it wasn't just this. Why? Because these were all pretty much within expectations. Now, I actually entered before this news, which could have easily stopped me out. And this is the thing, right? You're still not going to be right, even by implementing new information, because we're not getting the full benefits of full insider trading because we have to do it legally, which means that you're never going to be the first, but you can be a lot quicker and a lot faster than most people by understanding what they're looking at and what they're not looking at. And so we look at here, I didn't know anything about this news. So just for now, forget about this news. Okay. The reason I did this was because in the UK, what did we get an announcement of? We got an announcement that almost all taxes were going to rise. So in the UK, okay, this went against what the Labour government, which is the party in power. I never know whether they spell it Labour. I'm pretty sure they spell it like Fin on Labour. But anyway, went against the Labour promise. So when they were elected, they promised that they wouldn't boost a lot of taxes, and they've gone ahead and done it. And the consensus was clear: no one likes higher taxes. No one likes higher taxes. Why does no one like higher taxes? Well, number one, everyday people, why the hell would they like paying more? No one likes that. And then you've got people that own businesses, right? And investors. Why are they going to want to invest in a country or start a business in a country where they're getting charged more to operate in that country? Why wouldn't they just go and set it up in a tax-free state or a more tax-efficient state like Dubai or Cyprus or the Cayman Islands? And so what I'm trying to get at is that the UK becomes less attractive to businesses and it becomes less attractive to the people that actually live in the UK. And therefore, the consensus is far more likely to be negative, right? And so based on this information, right, I saw this by looking at the news. I wasn't looking at the financial news. I was looking at the news and I saw that, okay, the bias is probably more likely to be bearish. And so I sold. I didn't really give too much of a shit about what the candles were doing or anything like that. This just happened to be the time that I was looking at the market anyway. I saw this. I thought it was more likely. If it had gone against me, depending on how it had gone against me, I probably would have entered again, depending. And then from there, it was all about just monitoring how the news is affecting price. Now, for the first hour, this news didn't really affect price all that much. The second hour, you could say that it was a blend of this news and the GBP sentiment that put prices down. But the surprise here wasn't actually that bad, right? The personal spending went up in the US. That is a good thing for the US, right? And so, in theory, this should mean this was kind of an extra boost to the price, right? Because the sentiment in the pound was weak because of these tax hikes. And the US was seeing something that was slightly above expectation, which was just fuel to the fire, right? And everything else, okay, again, because you don't have to be perfect, you don't have to be right every time. Everything else you just leave to the risk management, to having that asymmetric risk management. This to me has always been, well, since I started using it, has always been far more effective than me drawing any line on a chart or drawing any, trying to get a perfect entry and trying to refine it and draw all this sort of bullshit on the chart. This has been far more effective than any of that because it makes sense. This is how we are operating. Now, the only other element that I will give you a hint about, but I won't explain everything in detail, is the only other thing to look at would be time horizon. Here, this was a very short time horizon. We were in and out within the same day, entered on Thursday, exited on Thursday. The holding time, by the looks of it, was about 4 or 5 hours, right? This would be different if we were looking for a longer term play. We were looking for a play that lasted a week, a month, 3 months. The way that this would have been executed would have changed significantly. You have to understand with new information, and this is really where the skill of one of the areas where the skill of this type of approach will be found, right? And where it can be improved. We understanding, okay, the type of news that we have, so the type of news and the impact that has on specific time horizons. Because it's all very well and good finding this category of stuff and being like, yep, it's game-changing information, it's brand new, and it's clearly negative. That's great, but you need to understand, okay, How do different time horizons react? I'll give you a hint. The lower down you go, right? So the lower down you go on these time frames up here, the more it is going to be influenced by overreactions and emotions. And then over time, it will reach some sort of an equilibrium. We see this happening on a micro scale right now. We had a sharp sell off. Then, as people are trying to reestablish value, we have started essentially moving sideways. We retrace back up as people aren't sure whether it's important or not, etc. And then we will wait for more new information, etc. And obviously, throughout this period, there has been new information coming out as well, right? So let's just look at what that new information was here. We obviously had non-farm payrolls and all this sort of stuff, right, etc. Right now, the goal really is not to over confuse because it's very easy to look at this and kind of be like, oh yeah, but this said this, and then you look at the other news around this time. Really, it's just about identifying the big domino moves, right? I love this kind of I don't this is not an exact quote from Warren Buffett, so forgive me, Warren. So if you don't know who Warren Buffett is, one of the greatest investors of all time. One of his favorite quotes of mine, and this is not a quote, I'm paraphrasing massively, but it's essentially that good opportunities don't come around uh, the time or very often, right? Why is this relevant? Well, because the best opportunities with an approach like this aren't going to be like day trading every single day. Like it's just not, right? It's not to say there's anything wrong with that, but if you're going with a new information based trading approach, right, you're not going to find those monumental edges through new information every single day because new information that's really impactful that meets all the criteria doesn't come around every day. Believe it or not, the UK or other countries aren't just massively increasing taxes randomly all the time. Like it's not doesn't happen all the time, right? And so it does require a little bit more patience. And it also requires understanding time horizons, as I mentioned. But the good thing is it's a lot more hands off, and I find that it's a lot higher probability as well. And so for those people who have a full time job, who have other things, or maybe have an advantage in another way, then think about what your advantages actually are, and think about how much time this could actually save you. So I'll leave you with this, right? And this is one question you've got to ask: what advantages do you have over everyone else? Now, this is not to say that if you are in a position where you do have access to information, such as working for a publicly traded company before everyone else, this is not to say that you should ever insider trade. I'm actively saying never, ever do that. However, what I am saying is I'm saying, what advantages do you have? What do you know? What could you know before most people become aware of it? Because believe it or not, people are stuck in their ways. People have certain opinions about things. Is there any information you can get access to that's public information, but most people maybe don't consider it that important? And you can translate that into a trading opportunity, right? This is something that you're not going to master overnight, but it's something that has been extremely, extremely powerful for me. And over time, this will probably become my main and only real trading approach, right? Because it's extremely hands off, which is what I like. It makes sense. It's extremely high probability if you do it correctly. And so this is really where those big edges come from, right? If you think about what most of the best investors are doing of all time, because they're doing it long term, they typically can't get access to brand new information. But if you're going to be someone that's more short term, so basically anything under like 6 month holding periods, I consider fairly short term. Then this is going to be something that a lot of people will benefit from. And so advantages can come from anywhere, though, right? You know, you've got to think about, especially with currencies, most of the information is going to be publicly available anyway. But I'd be thinking in terms of, okay, let's just say there's a survey about like inflation data coming out. Is there any way that I can get access to that inflation data or make my own estimates about that inflation before it even comes out? Now, this would be a very advanced technique, guys. This is going to be for those that are very, 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 very advanced. But just trying to make your brain work. You know, for example, unemployment. Is there a way you can kind of gain an estimate about what the unemployment is going to be before it comes out? And is that different to what everyone else expects? Can you be accurate with that enough and often enough for it to be significant enough? These are just two very, very easy examples. They're very hard to implement, but they're very, very easy to describe. But it can even be little things like, are you seeing certain behavior in your home country that you think the government is going to respond to a certain way based on how they've responded to it in the past? Can you get those insights before everybody else? Then that alone is going to be the foundation for a bias, right? A potential bias. Now, of course, guys, this is an extremely simplistic overview, right? This is so simple. Please do not watch this and think, oh my God, great. Like I can just run to the hills with this, because that's not how it works, right? This is going to require a lot of skill. It's going to require time, right? It's not going to be that easy. So hopefully I've got your brain working though. That was my goal of this video. Hope you've enjoyed. If you've got any questions, let me know below. If you like one-on-one help, let me know below. Take care, guys. Wish you all the best, and I'll see you very, very soon.